Unlocking the language of business, exploring key financial ratios. Hello, language enthusiasts. Today we're going to navigate the complex yet intriguing world of accounting and financial statements, focusing particularly on key financial ratios. Financial ratios are an essential part of the language of business. They help us understand a company's performance, financial health, and profitability. So let's jump right in. Financial ratios are mathematical comparisons of various financial data points from a company's financial statements like the income statement, balance sheet, and cash flow statement. These ratios are used to evaluate various aspects of a company's operational performance. Understanding and using these ratios is a vital skill for anyone interested in business and finance. Now, let's discuss some of the most important financial ratios you should know. First up, we have liquidity ratios. These ratios measure a company's ability to meet its short-term financial obligations. Two crucial liquidity ratios are: 1. Current ratio. This ratio compares a company's current assets to its current liabilities, indicating its ability to cover short-term liabilities with its short-term assets. 2. Quick ratio, acid test ratio. It is a stricter measure of liquidity. It excludes inventory from current assets before comparison with current liabilities, as inventories may not be easily convertible to cash. Next, we have profitability ratios. These ratios measure a company's ability to generate profits. Here are two key profitability ratios. 1. Net profit margin. It measures the percentage of revenue left after all expenses have been deducted from sales. It reflects the profitability of the company per dollar of sales. 2. Return on equity, ROE. It measures how effectively management is using a company's assets to create profits. Our next stop is efficiency ratios. These ratios measure how effectively a company uses its assets and liabilities. A couple of important efficiency ratios are: 1. Inventory turnover. This ratio shows how many times a company's inventory is sold and replaced over a period. 2. Asset turnover. It measures a company's ability to generate sales from its assets. Finally, let's look at solvency ratios. These ratios measure a company's ability to meet its long-term debt obligations. Key solvency ratios include: 1. Debt-to-equity ratio, DE. It compares a company's total debt to its total equity, indicating the proportion of company's financing that comes from debt versus equity. 2. Interest coverage ratio. It measures how easily a company can pay its interest expenses on outstanding debt. And there you have it, a quick tour of the key financial ratios used in business and finance. Remember, financial ratios are the language through which businesses communicate their performance. By understanding these ratios, you'll have a stronger grasp on business conversations. Thank you for joining me on this language learning journey. I hope this video has been helpful, and I look forward to seeing you in our next lesson. Until then, keep learning, and stay curious.